Mark your calendar for July 14th. On that single day, three of the most consequential economic data releases in the world will land simultaneously. The June Consumer Price Index, the inflation number that tells the Federal Reserve whether price pressures are still accelerating. Kevin Walsh's congressional testimony, the first time the new Fed chair will answer questions under oath about where interest rates are going. And the earnings reports of JPMorgan Chase, Bank of America, Goldman Sachs, Wells Fargo, and Citigroup, the five banks whose balance sheets collectively reflect the health of the entire American financial system. Three numbers, one day, a financial system already under the stress that this series has spent 13 videos documenting. History has seen this combination before. Not often, not in routine years, but in the specific years that financial historians later mark as turning points, years where the convergence of inflation data, central bank signals, and bank earnings in a single compressed window reveals something about the underlying state of the system that normal markets in normal times would have processed more gradually. This video is the history of those moments and what it tells you about July 14th. Financial markets process information continuously. Every day brings economic data, corporate earnings, central bank communications, geopolitical developments, a constant stream of signals that traders, investors, and institutions absorb, interpret, and price into markets in a rolling, distributed fashion. This distributed processing is, under normal conditions, one of the market's most stabilizing features. When information arrives gradually, each piece gets analyzed in context, interpreted through existing frameworks, and priced incrementally. Surprises get absorbed, mistakes get corrected. The market converges, however imperfectly, on something close to accurate valuations over time. Convergence days break this mechanism. When multiple highly significant data releases land simultaneously, when the inflation number, the central bank signal, and the bank earnings all arrive on the same morning, the distributed processing advantage disappears. Every major market participant receives multiple contradictory or reinforcing signals at once. The interpretive frameworks that work well for single data releases struggle to integrate multiple simultaneous inputs, especially when those inputs interact with each other in nonlinear ways. Inflation higher than expected means the Fed needs to hike more. Fed hiking more means bank earnings under pressure from higher funding costs. Bank earnings under pressure means lending contracts. Lending contraction means economic slowdown. Slowdown means inflation might eventually fall, but slowly and through a painful adjustment that different actors will experience very differently. This chain of interactions, which markets can process sequentially over weeks when data arrives gradually, must be processed simultaneously on a convergence day. The result is systematic mispricing in the short term, sometimes in the direction of panic, sometimes in the direction of false reassurance, as different market participants weight the simultaneous signals differently. The historical record on convergence days shows that they are disproportionately represented among the market's most significant single-day moves. Not because the information content is necessarily more significant than information released on other days, but because the processing challenge concentrates uncertainty and volatility in a way that normal data calendars do not. The most direct historical parallel to the current July 15th convergence is the series of compressing data releases in the autumn of 1973 that made the stagflation of the decade impossible to deny, and that fundamentally changed the Federal Reserve's operating environment in ways whose consequences played out across the rest of the decade. The context was structurally similar to the current moment in several important respects. Inflation had been elevated for several years, driven initially by the fiscal expansion of the Vietnam War era, then by the monetary accommodation of the Burns Fed, documented in the 11th video of this series. The Federal Reserve was under political pressure to avoid the rate hikes that inflation called for. And the banking system, which had expanded its balance sheet aggressively through the 1960s and early 1970s, was facing the early stages of a stress that would become much clearer later. In October 1973, three things happened in rapid succession. The Arab oil embargo began following the Yom Kippur War, driving oil prices to levels that immediately fed through to CPI. The Federal Reserve, caught between the inflation the embargo was accelerating and the recession it was also likely to cause, sent contradictory signals about its policy intentions. And the banking sector, whose earnings reflected both the economic disruption and the interest rate uncertainty, reported results that suggested the era of easy credit expansion was ending. None of this individually was a surprise to market participants who had been watching carefully. What made the autumn of 1973 a turning point was the convergence, the simultaneous arrival of signals that, taken together, forced a reinterpretation of the entire economic framework that markets had been operating under. The narrative that inflation was temporary, that the Fed would manage it without serious disruption, and that bank earnings would continue their expansion trajectory. All three components of that narrative were challenged simultaneously, and the market's response was to reprice equities sharply downward in a move that persisted for over a year. The S&P 500 fell approximately 48% from its January 1973 peak to its October 1975 trough, one of the worst bear markets in post-war American history. And the starting gun for that decline was not a single catastrophic event. It was a convergence of signals in a compressed period that forced market participants to update their models simultaneously. The second historical convergence that the July 14th setup most closely resembles is the autumn of 1986, specifically the weeks leading up to Black Monday on October 19th, when the Dow Jones Industrial Average fell 22% in a single day, the largest single-day percentage decline in its history. The 1986 episode is instructive for what it reveals about how convergence conditions can build beneath the surface of an apparently stable market before expressing themselves suddenly and catastrophically. By the summer of 1987, the American stock market had been in a powerful bull run for 5 years. Corporate earnings were strong, economic growth was solid. The market's price-to-earnings ratios were elevated, stocks were expensive by historical standards, but the prevailing narrative was that the new era of disinflationary growth justified those valuations. Beneath this surface stability, however, a series of conditions were converging in ways that reduced the market's resilience to shock. Interest rates had been rising through 1987 as the Federal Reserve, under the new chairmanship of Alan Greenspan, who had taken over from Paul Volcker just 2 months earlier in August 1987, responded to inflationary pressures that were beginning to reassert themselves. Rising rates were compressing the valuation case for equities. The dollar was weakening, the trade deficit was widening. An international coordination on exchange rates and interest rate policy, the Plaza Accord of 1985 and the subsequent Louvre Accord of 1987, was fraying. The specific trigger for Black Monday was a convergence of signals across a single week. A worse than expected trade deficit report raised fears about dollar weakness and potential Fed tightening. Congressional proposals to reduce the tax deductibility of debt used in corporate mergers threatened a major source of equity market demand. German interest rate increases signaled that international coordination was breaking down, and Greenspan, barely 2 months into his chairmanship, had not yet established a kind of market credibility that would allow his communications to stabilize expectations. The convergence of these signals across a single week created the conditions for Black Monday, a day where the interactive effects of simultaneous negative signals produced a market move far larger than any individual signal would have justified. The 1987 parallel to the current moment is specific and uncomfortable. Walsh, like Greenspan in 1987, is a new Fed chair whose credibility has not yet been established by demonstrated action. The market, like 1987, is elevated by historical standards, and the convergence of inflation data, Fed communication, and bank earnings on a single day creates exactly the kind of multi-signal environment where interactive effects can produce moves larger than any individual signal would suggest. The most extreme historical example of a financial convergence, and the one whose lessons are most directly applicable to the structural vulnerabilities this series has documented, is the single week in September 2009 that transformed a financial stress period into a global crisis. The week of September 30 to September 19, 2009 is the most compressed and consequential convergence in modern financial history. Within a single week, Fannie Mae and Freddie Mac were placed into government conservatorship. Lehman Brothers filed for bankruptcy. Merrill Lynch was sold to Bank of America in an emergency weekend transaction. AIG required an $85 billion government bailout to prevent its collapse. The reserve primary money market fund broke the buck, triggering a run on money market funds globally, and the Federal Reserve and Treasury announced emergency programs of a scale without precedent in American financial history. Each of these events was individually significant. Together, in the space of a single week, they produced a cascade that froze credit markets globally, triggered the deepest recession since the Great Depression, and required multi-trillion-dollar interventions by central banks and governments across the developed world to prevent a complete collapse of the financial system. The 2008 convergence was more severe than anything the current July 14th setup implies. The structural vulnerabilities that made 2008 catastrophic, the extreme leverage in the financial system, the opacity of mortgage-backed securities, the interconnections between seemingly unrelated financial institutions were of a different order than the current situation. But the lesson of 2008 that is directly relevant to the current convergence is not about the specific mechanisms of the crisis. It is about the failure of market participants, regulators, and policymakers to recognize that individually manageable risks were interacting in ways that made the combined system fragile in ways that no individual analysis captured. The bank earnings that preceded September 2008, reported in July and August of that year, contained signals that, in retrospect, clearly indicated the deteriorating quality of bank assets. Those signals were available. They were not adequately integrated with the simultaneous signals from housing markets, credit spreads, and Federal Reserve communications into a coherent picture of system-wide vulnerability. The question that July 15th forces is whether the bank earnings, inflation data, and Fed testimony that land simultaneously on that date will be processed as routine, separated data points, or whether they will be read as components of a system-level signal that their convergence makes unusually legible. The earnings reports from JPMorgan, Bank of America, Goldman Sachs, Wells Fargo, and Citigroup that land on July 14th are not merely financial news. They are a window into the health of the institutions whose balance sheets underpin the entire American financial system and whose vulnerability or resilience will determine how the structural stresses this series has documented ultimately express themselves. Each of the 5 banks reporting that they carry specific exposures that are directly relevant to the themes of this series. Treasury exposure. Every major American bank holds substantial quantities of U.S. Treasury bonds as part of their liquidity portfolios, the high-quality liquid assets that regulatory frameworks require them to maintain. As this series documented in its first video, Treasury yields have risen substantially from their post-2008 lows. Rising yields mean falling bond prices. The banks that accumulated Treasury holdings when yields were near zero, as they did during the 2020 and 2021 period of Federal Reserve quantitative easing, are sitting on unrealized losses that become increasingly significant as yields rise further. This is the mechanism that destroyed Silicon Valley Bank in March 2033. SVB's collapse was not caused by bad loans or risky investments. It was caused by a duration mismatch. Long-duration Treasury bonds whose value had fallen as yields rose, combined with a depositor base that could move quickly. The 5 banks reporting on July 14th are far larger and more diversified than SVB, but they all carry the same fundamental exposure, at varying scales and with varying degrees of hedging. Loan quality, the combination of persistent inflation, the interest rate environment, and the economic stress from the Iran conflict and its energy price consequences, has been working through the real economy for months. The loan books of major banks, commercial real estate, consumer credit, corporate lending, will show in the July 14th earnings the extent to which that economic stress has translated into deteriorating credit quality, rising delinquencies, increasing loan loss provisions, and declining net interest margins in a complicated rate environment will all be visible in these results. Trading revenues. The volatility that the Strait of Hormuz conflict, the ceasefire collapse, and the treasury market stress have generated in financial markets creates both opportunities and risks for the trading desks of major banks. Strong trading revenues can offset credit deterioration, as happened in several post-2012 quarters when banks benefited from market volatility even as their lending books were under stress. The composition of July 14th earnings, whether strength is coming from trading or from core lending, will tell a significant story about the underlying health of the institutions. Kevin Walsh's congressional testimony on July 14th is, in isolation, a routine semi-annual event. The Federal Reserve Chair's appearance before the House Financial Services Committee, required by the Humphrey-Hawkins Act. In the current context, it is anything but routine. Walsh arrives at that testimony carrying three specific burdens that no previous Fed chair in recent memory has faced simultaneously. The first is the dot plot abstention documented in the 11th video of this series. Congress will ask him directly, why did you not submit a forecast? What does that abstention signal about your policy intentions? Walsh's answers will be the first substantive public communication about his monetary philosophy under conditions where he cannot be cryptic or indirect. Congressional testimony, unlike FOMC press conferences, involves direct questions from legislators who are not bound by the conventions of financial journalism. The second is the inflation number that lands on the same morning. If June CP comes in above expectations, if inflation is accelerating rather than moderating, Walsh will be testifying about it in real time, with markets watching every word for signals about whether the July rate hike that markets are now pricing at 36% probability becomes a certainty. The interaction between the CPI release and the testimony unfolding simultaneously creates a communication challenge without clear precedent in recent Fed history. The third is the political pressure that surrounds any Fed chair testimony under the current administration. The Trump administration has been explicit about its preference for lower interest rates. Congress, whose members face constituent pressure about mortgage rates, small business borrowing costs, and housing affordability, will press Walsh from multiple directions. His ability to maintain the appearance of independence, to give testimony that is credibly about monetary economics rather than political accommodation, will itself be a market signal. The historical precedents for Fed chair testimony at moments of genuine monetary stress are instructive. Arthur Burns's congressional testimonies in 1973 and 1974 were masterclasses in the art of finding reasons to avoid the tightening that inflation required, each time finding a new structural explanation for why raising rates was not yet warranted. Paul Volcker's testimonies in 1979 and 2000 were models of unflinching clarity about what he intended to do and why, even as Congress pushed back vigorously. July 14th will reveal more clearly than any previous public appearance which template Walsh's Fed intends to follow. The June Consumer Price Index report that lands on the morning of July 13th is simultaneously the most important single data point of the current economic moment and the one most likely to be misread in the direction of false reassurance or false alarm. The structural inflation that this series has documented, driven by the petrodollar vulnerability, the energy supply disruptions from the Hormuz conflict, the middle-class wealth destruction that feeds wage price dynamics, and the fiscal expansion that monetary policy has been unable to fully offset, is not well captured by any single monthly CPI reading. Monthly CPI is volatile. It can move significantly from month to month based on factors that have nothing to do with the underlying inflationary trend. Seasonal adjustments, energy price timing, specific commodity movements. A single month's reading that comes in below expectations can create the impression of disinflation progress that subsequent months then reverse. A single month above expectations can generate crisis-level concern that overstates the underlying acceleration. The historical record on CPI readings at moments of structural inflation transition is specifically relevant here. In the 1973 to 1974 period, monthly CPI readings repeatedly appear to stabilize before accelerating again. The so-called head fakes of the stagflation era that repeatedly led policymakers and markets to conclude that inflation had peaked when it had not. Each apparent moderation was followed by a new acceleration until the embedded inflationary psychology that Burns had allowed to develop required Volcker's extreme measures to break. The June 2026 CPI reading will be interpreted through the lens of whatever narrative is dominant at the moment of its release. If markets have priced in continued deceleration, a number above expectations will be more disruptive than if expectations are already elevated. If the number confirms deceleration, it will provide temporary relief, even if the structural conditions driving inflation remain intact. What the number will not tell anyone, regardless of what it says, is whether the structural inflation dynamic this series has documented has been resolved. That question requires not a single monthly data point, but a sustained pattern across multiple months and multiple indicators. July 14th CPI release is one data point in that pattern. It is not the pattern itself. Given the historical precedents examined in this video, the 1973 stagflation convergence, the 1973 stagflation convergence, the 1987 Black Monday sequence, and the 2008 crisis cascade, how should someone equipped with the analytical framework this series has built approach July 14th? The first principle from the historical record is to resist the immediate interpretation. Convergence days consistently produce either excessive panic or excessive reassurance in their immediate market response, followed by a more accurate assessment over the subsequent days and weeks. The people who made the most consequential errors at each of the historical convergences examined in this video made them in the immediate hours and days of the convergence, when the simultaneous signals were hardest to integrate, not in the weeks that followed when the individual components could be analyzed separately. The second principle is to weight the interaction effects, not just the individual signals. July 14th significance is not primarily in what each individual data release says, it is in what the combination says about the current state of the system. CPI above expectations plus Walsh testimonies suggesting limited appetite for aggressive tightening plus bank earnings showing credit stress is a very different combined signal than CPI below expectations plus clear Walsh commitment to price stability plus bank earnings showing resilience. The interaction of the three signals is the message. The third principle is to distinguish between the convergence immediate market impact and its implications for the structural trajectory this series has been documenting. In 1973, markets fell sharply on the convergence, but the stagflation decade had years to run. In 1987, Black Monday produced its 22% single-day decline, but the bull market resumed within months, as the structural conditions for growth were still intact. In 2008, the September convergence was the beginning of a crisis whose full expression took months to complete. July 15th will not by itself determine the outcome of the structural transition this series has spent 14 videos analyzing. It will provide new data that either confirms, challenges, or complicates the framework. The analytical discipline is to hold the framework steady enough to evaluate the data against it, without either dismissing signals that genuinely update the analysis or overcorrecting to each data point in isolation. The historical record on convergence days is not that they are always catastrophic. It is that they are informative in proportion to how carefully they are read. And reading them carefully requires exactly the kind of historical pattern recognition that this series has been building. Not to predict the outcome of a single day, but to place that day accurately within the longer arc of the transition it is part of. July 13th is 3 days away. Three numbers will land on the same morning in the same hours, demanding to be read simultaneously by the same market participants who are already navigating the most complex financial environment. Since 2008, history does not tell us what those numbers will say. History tells us what convergences like this one have revealed in the past, about the underlying health of the financial system, about the credibility of the institutions managing it, and about the gap between the narratives markets are operating on and the structural realities those narratives may be obscuring. This channel will be watching July 14th through the same historical framework that has guided every video in this series, not to predict what the numbers will say, but to read what they reveal about where the current moment sits in the transition that 14 videos have now documented from every angle. Subscribe, because on July 13th the data lands, and the question is whether you're reading it or just reacting to it.